Welcome to Talk Tickers. We are glad you're with us.
Great to be here.
Usually on this show, we are, tearing apart a specific quarterly report, looking at guidance, or maybe analyzing a merger arbitrage opportunity.
The micro stuff, the individual trees.
Exactly. We look at the trees, but today we are zooming way out. We are looking at the forest, and frankly, the forest is on fire.
That's a pretty fair description.
Yeah.
We're not talking about a single company's earnings. We're looking at the earnings environment.
Right.
Because here's the reality, and it's a harsh one. You can have the best bottom-up thesis in the world. You can pick the absolute best house on the block, pristine balance sheet, great moat, fantastic management, increasing margins, all of it.
The perfect stock pick.
The perfect stock pick. But if the entire neighborhood is sliding into a sinkhole, your valuation model is worth zero.
That is the classic distinction between alpha and beta, isn't it? We spend all our time hunting for alpha, for that stock selection edge.
We do.
But today is about systemic beta. It's about what happens when the macro floor literally falls out from under your micro thesis.
Exactly. And to really understand that, to see it in its purest form, we are going back to 1997. We're talking about the Asian financial crisis.
Now, before you, our listener, roll your eyes and think, great, a history lesson, I'll skip this one, just wait.
Please wait, because I'll stop you right there. This is not about memorizing dates for a quiz. This is the definitive case study in what we call hot money. It is a master class in currency pegs, the difference between liquidity and solvency.
And the mechanics of what happens when a central bank's currency defense fails.
It's all there. If you were deploying capital in emerging markets today, or frankly, if you were just trading multinationals with heavy FX exposure.
Or even looking at crypto stablecoins, which are basically just unregulated currency pegs.
That is a fantastic point. This is the autopsy you absolutely need to understand.
It's the blueprint.
It really is the blueprint. When we look at market collapses, whether it's the dot-com bubble, the great financial crisis, or even modern flash crashes, they often have unique triggers. But the mechanics of the unwind, they're surprisingly consistent.
And the Asian financial crisis, the AFC, is maybe the purest example of a leverage cycle gone completely wrong.
It really is. It highlights just how quickly a miracle economy can turn into a liquidation sale if the capital structure is fundamentally flawed.
Okay, so let's set the scene. We're in the mid-90s. The term you heard everywhere was the Asian economic miracle.
Well, it wasn't just a headline. It was the ethos of the era.
Right. And you had the Asian tigers. Who were they again?
So the original tigers were South Korea, Taiwan, Hong Kong, Singapore. But then you had these up-and-comers, the newly industrializing economies, and that's where the real heat was.
We're talking Thailand, Malaysia, Indonesia.
Exactly. Those were the darlings of the investment world.
So give us a sense of the scale here. What were the numbers actually looking like?
The numbers were just staggering. We were seeing GDP growth rates of 8%, 10%, even 12% year over year.
And not just for 1 year.
Well, consistently.
Third.
And the sentiment. It's honestly hard to overstate just how bullish the world was. The World Bank, the IMF, everyone was singing their praises.
Yeah.
The dominant narrative was that these countries had somehow discovered a perpetual growth machine.
It was the perfect story, a Goldilocks scenario. You had high savings rates, disciplined workforces, pro-business governments. It all fit.
It all fit. And from a Western investor's perspective, you have to look at the alternative.
What was that?
The U.S. economy in the early 90s was sluggish. Coming out of a recession. Europe was struggling with integration. If you weren't allocated to Asia in 1995, you were basically failing your fiduciary duty.
You were leaving massive yield on the table.
That's it. It was the consensus trade. Everyone was in it.
But, and there's always a but, in these stories, there was a contrarian view forming.
There was.
And we have to talk about Paul Krugman here. In 1994, so this is well before the crisis, he wrote a paper called The Myth of Asia's Miracle.
And at the time, people thought he was completely nuts.
Just a pessimist, right. Just being gloomy for the sake of it.
Almost heretical.
Yeah.
It went against this incredible narrative of success. But Krugman made this fascinating economic distinction. He talked about the difference between inspiration and perspiration.
Okay, break that down for us. What's the difference?
So he argued that the growth we were seeing wasn't really driven by inspiration. Inspiration is, efficiency gains, better technology, working smarter. It's what economists call total factor productivity.
Getting more output for the same input.
Exactly. He said the growth was actually driven by perspiration, which is just a mass mobilization of resources.
Okay, so what does perspiration look like in an economy? I'm not totally clear on that.
It means you take a farmer from a rural area, you put him in a factory in the city, you take a woman who wasn't in the workforce, you put her on an assembly line, you borrow a ton of money to build a bridge where there wasn't one before. You're just adding inputs.
So it's input-driven growth. It's like you're pouring more ingredients into the pot, so of course you get more stew, but you aren't actually becoming a better cook.
Precisely. That is the perfect analogy. You're not getting a more flavorful stew per ingredient. You're just using a bigger pot and more water. It looks impressive on the surface, but the underlying efficiency isn't improving.
And eventually you run out of ingredients or the pot gets too big for the stove.
Exactly. The law of diminishing returns always wins. You can only move so many people from the farm to the factory. Eventually, you run out of that easy labor. You run out of those easy capital deployment opportunities.
So Krugman's point was that the miracle wasn't a miracle of productivity at all.
Not at all. It was just a massive accumulation of capital and labor. And the scary part was, if that capital flow stopped, or even just slowed down, the growth would stop too. It was the fundamental fragility that the market was completely ignoring because those headline GDP numbers looked so good.
Okay, so the engine is running incredibly hot, but it's running on borrowed fuel. Let's talk about that fuel, the capital flow, because this is the real engine of the crisis.
It is.
And to understand it, we have to unpack something called the impossible trinity. This is like Econ 101, but in the real world, it's where central banks go to die. Can you walk us through it?
Sure. The impossible trinity, or sometimes it's called the trilemma, states that a country can only have two of the following three things at the same time.
Okay.
First, a fixed exchange rate. Your currency is pegged to another, like the US dollar. Second, an independent monetary policy, meaning you can set your own interest rates to manage your own economy.
And the third?
And third, free capital movement. Money can come and go across the border as it pleases without restrictions.
So you get to pick two. You cannot have all three.
You physically cannot have all three. And just think about it for a second. It's very logical. If you fix your exchange rate to the US dollar and you allow capital to flow freely, you must import the monetary policy of the United States.
You lose control of your own interest rates.
You have to. If the U.S. Federal Reserve raises rates, you have to raise your rates to keep the peg attractive. If you try to keep your rates low while U.S. rates are high, what happens?
Everyone sells your currency to buy dollars to get that higher yield.
And your peg breaks instantly.
And the Asian tigers, and specifically Thailand in this case, they were trying to defy gravity. They wanted all three.
They were greedy. It's really that simple. Thailand, Indonesia, and others had effectively pegged their currencies to the US dollar. The Thai baht, for example, was locked in at around 25 baht to the dollar.
And it had been for a long time, right? It was seen as stable.
Incredibly stable. For over a decade.
Right.
At the same time, they opened their capital accounts, which allowed all this foreign money to flood in to fund the so-called miracle.
So they have the peg and they have the free capital flow.
But they still tried to keep their domestic interest rates high. They wanted to control local inflation, manage their overheating economies, and that created a massive distortion.
Okay, and for our listeners, I really want to pause here because this is the key mechanic you have to understand. This is the carry trade on steroids.
It is the original large-scale carry trade.
So let's role play this so everyone gets it. I'm a Thai bank or a Thai corporation in, say, 1995. I want to build a luxury condo tower in Bangkok.
Okay.
I can go to a local Thai bank and borrow in baht. What's my interest rate probably looking like?
In baht, the local economy is hot, inflation is bubbling up, you're probably paying 13, 14, maybe even 15% interest.
Ouch, okay. But the capital account is open. I can call up a bank in New York or Tokyo. What's my rate if I borrow in US dollars?
In 1995, US rates were much lower. You're looking at maybe 5 or 6%.
So I have a choice. I can pay 15% at home, or I can pay 6% abroad. And the government has promised me that 25 baht will equal $1 forever. What am I going to do?
You are going to borrow in dollars every single time. It's a complete no-brainer.
Right.
You take that cheap dollar loan, you convert it to baht, you build your condo tower, and you are pocketing that massive spread, that 9% differential. It feels like free money. It feels like pure arbitrage.
It's the ultimate arbitrage, but it relies entirely 100% on one single thing.
The peg holding.
The peg holding. Because if that peg breaks, my liability, the money I owe in dollars, explodes in value relative to my assets, which are all in baht.
Exactly. And because that peg had held for so long, over a decade, people stopped hedging. They stopped buying insurance against the currency moving.
Why would you? It's just an extra cost.
It felt like a waste of money.
Yeah.
They believed the government. They confused a low probability with an absolute certainty. And that's a fatal mistake in finance.
Okay, so that brings us to the setup for the crisis itself. Where in 1995, 1996, the environment starts to shift. The U.S. economy is recovering from that early 90s gloom.
Right. And Alan Greenspan is the Fed chair.
And he sees the economy picking up, so he starts raising interest rates to head off inflation. When U.S. rates go up, the U.S. dollar strengthens.
And this is where that peg goes from being a benefit to being a noose. Because the Thai baht, the Malaysian ringgit, the Indonesian rupiah, they are all tied to the dollar. When the dollar goes up against the rest of the world,
They go up against the rest of the world, too.
they're dragged along for the ride.
It's like being handcuffed to a rocket ship you can't steer.
That's a great analogy.
Yeah.
Yeah. Now, look at their neighbors and competitors. Japan is a huge trade partner for Southeast Asia, but the yen was weakening at the time.
So Japanese goods are getting cheaper.
And even more importantly, China had just devalued its currency, the renminbi, back in 1994. So all of a sudden, Thailand's exports are becoming incredibly expensive compared to goods from China and Japan.
They're pricing themselves out of the market.
They are. The miracle growth engine exports, it starts to sputter.
Sputter is a mild word for it, isn't it?
Well, it didn't just sputter, it stalled completely. In 1996, Thai export growth flatlined. It went to 0% growth.
Zero, after years of double-digit expansion.
Zero. At the same time, you had the global semiconductor market crashing. Prices for memory chips just fell off a cliff, which absolutely hammered countries like South Korea who were heavy into electronics. So the macro fundamentals are clearly deteriorating. The revenue side of the country's P&L is shrinking.
But the expense side, that borrowing, is accelerating.
It's accelerating wildly. This is where we see the asset bubbles really inflate. You have this mechanism in Thailand called the BIBF.
The BIBF.
The Bangkok International Banking Facilities. It was set up in 1993, and its purpose was essentially to make it easier to borrow foreign money. The idea was to make Thailand a regional financial hub, but in reality, it just acted like a fire hose of cheap liquidity.
It opened the floodgates.
It did. By early 1997, foreign debt in Thailand was over $109 billion. Now, $109 billion is a big number, but it's the context that really matters. The truly scary part was the structure of that debt.
Okay, so what was the structure?
65% of that debt was short-term.
65%.
Yes, maturities of less than 1 year.
Hold on. I want to underscore that for a second. You're telling me that 2/3 of the country's entire external debt has to be rolled over, refinanced every single year.
That's exactly right. They were funding very long-term projects with very short-term paper, borrowing 90-day money to build 30-year infrastructure projects.
That is the absolute classic definition of a maturity mismatch. I mean, it works fine as long as your lender is happy to roll the loan over every 90 days, but if that lender gets spooked,
then you have a massive liquidity crisis on your hands. And where did all this money go? Did it go into building high-tech factories that could export goods to pay back the loans?
some of it, I assume.
Some of it, sure. But a huge amount went into non-productive, speculative assets. Luxury condos in Bangkok.
Golf courses.
Commercial real estate. There was a glut. Vacancy rates were soaring, but the building just kept happening because the financing was so cheap.
And that is the definition of hot money.
Precisely. It's seeking a quick return, not a long-term productive yield. It's fickle.
And we can't ignore the crony capitalism factor here. In places like Indonesia and South Korea, getting a loan wasn't always based on a credit check, was it?
No, not at all. And this just exacerbated the misallocation of capital. In Indonesia, under President Suharto, if you were connected to the first family or you were a friend of a friend, you got a loan.
Didn't matter what your business plan was?
It didn't matter if it was written on a napkin. In South Korea, the problem was a bit different. The government directed credit to the chaebols, these massive family-run conglomerates like Hyundai, Samsung, Daewoo.
Right.
And their focus was on empire building, on revenue growth, on market share, not necessarily on profitability or return on equity. So they were leveraged to the hilt.
Okay, so let's just take a quick snapshot of the balance sheet of the region in early 1997. You have slowing exports, you have massive amounts of short-term foreign debt, you have asset bubbles in real estate and stocks, and you have a fixed exchange rate that is very clearly overvalued.
That is blood in the water for a certain kind of investor.
Enter the hedge funds.
The macro speculators.
The George Soros types.
Exactly. Soros, Julian Robertson, the Quantum Fund. They look at Thailand and they just did the math. They saw that Thailand was running a current account deficit of 8% of GDP.
Which means they're burning through cash.
They're burning cash. They need constant inflows of new foreign capital just to stay afloat. The speculators realized the reserves had been dwindling. They realized the emperor had no clothes, so what did they do?
They started shorting the baht.
They started selling.
Now, I want to get a little technical on the defense mechanism here, because central banks don't just roll over and give up, they fight.
Oh, they fight hard.
They view the currency peg as a matter of national pride, of credibility. So walk us through the mechanics of that battle in early 1997.
It was a war of attrition. The speculators would sell baht in the open market, trying to push the price down below 25. The Bank of Thailand would then have to step in and be the buyer of last resort.
They buy up all the excess baht.
Right. They'd use their US dollar reserves to buy baht to keep the price propped up at 25.
So they're literally burning through their savings account to support the currency.
Correct. But here's the trick. By May and June of 1997, the Bank of Thailand was running out of actual physical cash in the vault. They knew if they published their reserve numbers and those numbers showed something close to zero, the game would be over instantly.
It would trigger a panic.
A total panic. So they got creative. They started using the forward markets.
Explain that. How does a central bank use the forward market to hide its losses?
Okay, so instead of selling actual US dollars from their vault today, which would show up on their balance sheet immediately, they entered into these swap contracts. They promised to sell dollars in the future, say 3 months or 6 months from now, in exchange for baht.
Ah, so it supports the baht's value today?
Exactly. It creates demand today. But it doesn't immediately drain the reported spot reserves.
It's essentially off-balance sheet accounting. It's just kicking the can down the road.
It's pure window dressing. On paper, they were reporting foreign reserves of around $30 billion. The world looked at that number and said, okay, they have $30 billion. They can fight for a while.
But that wasn't the real number.
It wasn't the real number. They had these massive forward obligations, these promises to pay out dollars in the future that were almost equal to that amount. Their net usable reserves had dropped to something like $2.8 billion.
Wait, $2.8 billion for an entire economy the size of Thailand?
It's essentially zero. It's insolvency. They were driving the car at 100 miles an hour with the gas tank completely empty, just coasting on fumes and hoping nobody would notice.
So the speculators are hitting the bid, they're selling boat, Bank of Thailand goes to check the vault, and there's nothing left.
Correct. They couldn't defend the peg for another day. The forward book was full. Nobody would take the other side of that trade with them anymore. So on July 2nd, 1997, they capitulated.
They gave up.
They announced they were floating the boat. They abandoned the peg. I think they hoped it would depreciate maybe 10 or 15%, find a new stable equilibrium, and the crisis would be over.
I think the term they used was a managed float.
Chuckles. There was nothing managed about it. It crashed. It just went into absolute freefall.
How bad was it?
By January of 1998, just a few months later, the boat had lost more than half its value. It went from 25 to the dollar to 56 to the dollar.
And this is where the double mismatch just annihilates the corporate sector. This is the mechanic of bankruptcy that we really need to drill into.
This is the core of it.
So let's break down the double mismatch. I want to go back to our hypothetical condo developer. Let's call him Somsak. Somsak borrowed $100 million US to build his tower in Bangkok.
Okay, so let's look at mismatch number one. The currency mismatch. When the baht is at 25 to the dollar, Somsak owes $100 million. In his local books on his balance sheet, that liability is recorded as 2.5 billion baht.
Right. And his revenue is all in baht. He prices his condos in baht. He collects rent in baht.
His entire revenue stream is in the local currency.
Yeah.
Then the peg breaks. The baht goes to 50.
What happens to his debt?
Overnight, his $100 million debt goes from being a 2.5 billion baht liability to a 5 billion baht liability. His principal balance just doubled.
Did his revenue double?
No. Did the value of his condos double? No. In fact, his asset values probably dropped because the entire economy is cratering. He is insolvent instantly. His equity is wiped out 10 times over. It doesn't matter how good his condos are. The math is simply broken.
That's devastating. And that's just mismatch number one. What's mismatch number two? Maturity.
Right. Somsak didn't just borrow dollars. He borrowed short-term dollars because the rates were lower. Maybe he used 90-day commercial paper or one-year syndicated loans.
And he was just counting on rolling that debt over, right? He assumed that when the loan came due, the bank would just say, sure, here's another one.
Of course. That's how it always worked. But when the crash happens, the banks panic.
Confidence just evaporates.
Completely. The foreign banks, the Japanese, American, and European lenders, they call their country managers and say, we want our money back. We are not rolling over any more loans. Reduce our exposure to Thailand to zero now.
But Somsak can't pay. I mean, he poured the concrete, the money's in the building. You can't liquidate a half-built skyscraper in 24 hours to pay back a loan.
Exactly. He is illiquid, even if his business was theoretically sound in the long run. Even if people still wanted to buy condos eventually, he cannot meet his short-term cash call, so he's bankrupt.
And this wasn't just one guy. This happened to thousands of companies all at once.
All at once. It wasn't just developers. It was manufacturers, retailers, anyone who had touched that cheap dollar debt. The entire corporate sector was insolvent and illiquid simultaneously.
And this panic, it didn't stay contained in Thailand for long. We always talk about contagion. And this is the psychological aspect of markets that economic models so often miss.
They really do. Economists assume rational actors, but in a crisis, fear drives the bus.
So investors didn't wait around to check the books of the other countries.
No way. They operated on a simple heuristic. If Thailand looks like this, crony capitalism, real estate bubbles, and overvalued currency, then Indonesia, Malaysia, and the Philippines probably look the same.
It's the cockroach theory.
It's the cockroach theory. If you see one cockroach in the kitchen, you don't assume it's the only one. You assume there are 100 more behind the fridge. So capital fled the entire region. They sold first and asked questions later.
Let's talk about Indonesia. Because if Thailand was a severe recession, what happened in Indonesia was it was a societal collapse. The move in the rupiah was terrifying.
It was. The rupiah went from about 2,400 to the dollar to over 10,000. And eventually, it hit 17,000 at its worst.
Just imagine that destruction of purchasing power.
If you were an Indonesian citizen, your life savings essentially evaporated in global terms. And the companies with that unhedged dollar debt, they were just wiped off the map. In Indonesia, the corporate debt was massive and almost completely unhedged.
And this financial crisis quickly triggered a political crisis.
It did. You have to understand, in many developing nations, a currency crisis is an inflation crisis. Food prices skyrocketed. Cooking oil, rice, fuel, anything that was imported became completely unaffordable for the average person.
And that leads to unrest.
Massive unrest. There were riots in the streets of Jakarta, widespread looting. It ultimately led to the end of President Suharto's 30-year authoritarian rule. It just shows how quickly a currency crisis becomes a regime crisis. The social contract broke because the money broke.
And then there's South Korea. This is the one that always shocks me when I read about this. South Korea wasn't some developing backwater.
Not at all.
It was the 11th largest economy in the world, an industrial powerhouse. It had just hosted the Olympics.
Korea was a real shock to the system. It showed the contagion had reached the big leagues. The problem there was the cabals.
These huge conglomerates.
Right. And I had these complex systems of cross-guaranteed debt. So if a subsidiary of a massive group like Daewoo failed, it could pull down the whole group, which in turn could pull down the banks that lent to them. It was a house of cards.
And they had their own version of the short-term borrowing problem.
They did. They had these institutions called merchant banks that were engaging in really risky arbitrage borrowing short-term funds abroad and lending that money out long-term at home. When the Korean won collapsed, their debt to GDP ratio just exploded. The country was literally days away from defaulting on its sovereign obligations.
There's that famous story about the gold drive in Korea. I find that amazing.
Yes, it's actually quite moving. The government put out a call and asked citizens to help pay back the nation's foreign debt. Millions of ordinary Koreans lined up in the cold to donate their personal gold. Wedding rings, necklaces, athletic trophies, lucky keys.
Just giving it to the state.
Yes. It showed this incredible national unity, but it also showed the sheer desperation of the situation. They collected tons of gold, melted it down into bars, and shipped it out to pay foreign creditors. They were staring into the abyss.
So the entire region is burning. Capital is fleeing at an incredible rate. Who you call? The lender of last resort.
The International Monetary Fund, the IMF.
And they put together these massive rescue packages.
Unprecedented numbers at the time. About $17 billion for Thailand, $40 billion for Indonesia, and a whopping $57 billion for South Korea.
But that money came with a lot of strings attached, this concept of conditionality. This is where the whole history gets really controversial, right?
It does. The IMF didn't just write a check and walk away. They essentially took over the economic steering wheel of these countries.
And what did they demand? What was the prescription?
They applied a very orthodox, one-size-fits-all Western prescription. They looked at the situation and said, the number one priority is to stop the currency from bleeding. To do that, you have to restore confidence. And to restore confidence, you have to make your currency attractive to hold again.
And how do you do that?
You raise interest rates.
Aggressively.
I mean, we're talking about raising benchmark interest rates to 30%, 40%, or even higher. The logic is simple. If I pay you 40% interest, you won't sell your bet or your won to buy dollars.
But wait a minute. High interest rates also kill the local economy. If I'm Samsak, the developer, and my borrowing rate goes from 13% to 30%, I'm even more dead. My cash flow is completely gone.
That is a brutal trade-off. The IMF also demanded fiscal austerity. Cut government spending, raise taxes, balance the budget.
And the third piece?
They demanded immediate financial restructuring. In other words, close the insolvent banks, shut them down. In Thailand, they suspended 58 finance companies almost overnight. In Indonesia, they closed 16 banks.
And there is a ton of criticism about this approach. The main argument is that the IMF prescribed the wrong medicine.
Okay.
They treated this like a Latin American debt crisis, where the problem usually is a profligate government overspending, when this was actually a private sector banking and corporate crisis.
That is the core critique. Joseph Stiglitz, who was the chief economist at the World Bank at the time, was very, very vocal about this. He argued that raising interest rates on these highly leveraged companies that were already dying from the currency devaluation was essentially just executing them.
You're pushing them over the edge.
You turned a liquidity crisis where they just couldn't get cash into a solvency crisis where their entire business model was destroyed. You pushed companies that might have survived into bankruptcy.
And what about the bank closures? How did that play out?
It backfired spectacularly, especially in Indonesia. When they closed those 16 banks without having a full, credible deposit guarantee in place, everyone panicked. The average person thought, if those banks are closed, my bank might be next. So what did they do? They pulled their money out of the healthy banks to put it under the mattress or convert it to dollars. It caused a systemic bank run.
It's like yelling fire in a crowded theater to try and improve fire safety procedures.
That's a great way to put it. It made the panic worse.
No, to be fair to the IMF, they aren't stupid people. What was their counter-argument? Why did they think this was the right move?
No, they aren't stupid at all.
Yeah.
Their argument was that you had to stop the currency free fall at all costs. That was job number one. Because if the currency goes to zero or hyperinflates, that destroys the economy even more thoroughly. It wipes out the poor. It destroys all savings.
So stabilizing the exchange rate was the priority above all else.
Yes. They believed that without those painful rate hikes, the capital flight would simply never stop. It was a choice between two terrible options, and they chose the one they thought was less terrible in the long run.
It was a brutal, brutal situation. And eventually the IMF did soften its stance right now.
They did. By late 1998, they realized the fiscal tightening was too severe. They acknowledged that these governments actually had budget surpluses going into the crisis. The problem wasn't public debt, it was private debt.
So they changed course.
They allowed the governments to run deficits to create social safety nets to help the millions of people who had lost their jobs. But by then, a lot of the damage was already done. GDP in Indonesia fell by 13% in 1998.
That's a depression-level event.
It is. Millions of people fell back into poverty. The human cost was immense.
Okay, let's shift gears a bit and talk about the investor context. What changed after this? Because the Asia we see today is very, very different from the Asia of 1997. If you look at the central banks in that region now, they behave in a completely different way.
They do. And the single biggest lesson that Asian policymakers learned from this crisis was never lose your financial sovereignty to the IMF again.
They saw it as humiliating.
Deeply humiliating. And the way you ensure you never have to call the IMF is to make sure you never, ever run out of dollars.
So they became preppers, financial preppers.
That's a great term for it, basically.
Mm.
Post-1998, we saw this massive structural shift in their economic policy. These countries went from running current account deficits, meaning importing capital, to running huge current account surpluses, meaning exporting capital.
How did they manage that?
They manipulated their currencies, they actively kept them undervalued to boost exports, and they banked the difference. They started hoarding U.S. dollars.
They became hoarding machines.
Exactly. Just look at the foreign exchange reserves of China, Japan, South Korea, Thailand today. They are sitting on mountains of U.S. treasuries. Trillions and trillions of dollars. That is direct scar tissue from 1997.
They built a war chest.
A massive war chest, so that if the hedge funds ever came back to attack their currency, they could crush them. They wanted to have enough cash on hand to bail out their own banks without ever having to ask Washington for permission again.
And this actually had a huge global impact, didn't it? I remember Ben Bernanke, when he was Fed chair, talking about the global savings glut.
He did.
He argued that all this money flowing from Asia back into U.S. treasuries suppressed bond yields in the U.S. for years.
Which arguably helped fuel the 2008 housing bubble.
It's all connected.
It's all connected.
Yeah.
The response to one crisis lays the seeds for the next one. The ASC created this huge, inelastic demand for safe U.S. assets, which lowered U.S. interest rates and made mortgage borrowing incredibly cheap. History rhymes.
They also tried to fix the mismatch problem directly with the bond market.
Yes, that was another huge lesson. They started the Asian Bond Markets Initiative. They put a lot of effort into developing deep, liquid, local currency bond markets.
Why was that so important?
Because they wanted to be able to borrow in baht and won and ringgit, rather than being forced to borrow in U.S. dollars. If you borrow in your own currency, a currency you control, you can always print your way out of a crisis if you have to. You can't print dollars.
Right.
That's the original sin of emerging markets borrowing in a foreign currency that you cannot print.
Now, let's try and connect this to today. We still see carry trades all the time. The yen carry trade has been a huge story for the last couple of years. What is the signal an investor should watch for to see if a situation like this is developing?
The signal, paradoxically, is stability.
Stability is the danger sign.
Prolonged, artificial stability in a pegged or heavily managed currency breeds instability. This is the Hyman-Minsky idea, that stability itself breeds instability. When a currency flatlines for years, like the Thai baht did at 25, it encourages leverage. It lulls people into a false sense of security.
Investors stop hedging. They think the risk is zero.
They start to believe it's a law of physics, not just a government policy that can change overnight.
So if you see a currency chart that looks like a flat line for a long time, you should run.
Well, you should get suspicious. If you see a flat line while the underlying fundamentals are diverging, like if inflation is 10% in the emerging market and 2% in the US, but the exchange rate isn't moving, that is a ticking time bomb.
The pressure is building behind the dam.
Exactly. The pressure is building. And eventually the dam breaks. And when it breaks, it doesn't leak. It bursts.
And that impossible trinity we talked about at the beginning, it's still a prize. You cannot defy economic gravity forever.
It always applies. We see emerging markets trying to control their interest rates and their currency while keeping capital markets open. It eventually breaks. It always breaks the weakest link.
And that weak link is usually the currency peg.
Almost always. We saw it in Argentina multiple times. We saw it in Turkey. We saw it in Sri Lanka more recently. The script is remarkably similar.
I want to touch on one specific mechanism we kind of glossed over, but is so critical. Counterparty risk. You mentioned that companies weren't hedging, but some actually were, or at least they thought they were.
This is a vital point. Many Thai companies weren't totally reckless. They knew there was a risk, so they did the responsible thing. They bought forward contracts to lock in an exchange rate. They bought insurance.
So what was the problem?
The problem was who they bought the insurance from. The insurer was usually a domestic Thai bank.
So they bought fire insurance from the guy living in the same burning building.
That is the perfect way to describe it. When the crash happened and the baht collapsed, the banks themselves became insolvent. So the insurance that the companies had bought was completely worthless because the counterparty couldn't pay out on the contract.
That is such a crucial insight. Your hedge is only as good as the solvency of the bank standing behind it.
Exactly.
If I buy a put option to protect my portfolio, I need the person who sold me that put to be solvent when the market crashes.
Yes. Counterparty risk is the ghost in the machine during every single financial crisis. It's what happened with AIG and credit default swaps in 2008. It's what happened in 1997. You always have to ask, who is on the other side of this trade, and can they actually pay me if things go wrong?
And one final structural point I want to hit on, the difference between public and private debt. In 1997, a lot of analysts looked at sovereign debt to GDP for these countries, and it looked low. The governments were prudent, they were running surpluses.
The leverage was hidden. It was all on the corporate balance sheets. Analysts were looking at the government's credit card, which was clean, while the corporations were maxing out 10 of their own.
And today, we often make the opposite mistake. We stare at government debt and ignore the leverage building up in the private sector.
We do. You have to look at the total debt in the system. Because as we saw in 2008 and 1997, private debt becomes public debt in a crisis. The government always has to step in and bail everyone out.
Okay, that brings us to our closing segment, the one question. Based on this entire autopsy of the 1997 Asian financial crisis, what is the one single question every investor needs to ask when they're looking at a foreign investment or even a multinational with global operations?
The question is very simple. It is the debt denominated in the same currency as the revenue?
Is the debt denominated in the same currency as the revenue? Why does that matter more than anything else?
Because leverage is not a static number on a spreadsheet. If you owe dollars but you earn baht, or you owe euros but you earn Turkish lira, your leverage ratio is a function of the exchange rate. It's a moving target.
So a big move in the currency can change everything.
A 20% move in the currency can turn a profitable, safe, blue-chip company into an insolvent liquidation target overnight. When you buy that company, you aren't just taking on credit risk, you are taking on massive, unhedged FX risk on the entire capital structure.
So if you're looking at a Brazilian company or a Turkish company or an Indian company, the first thing you do is check the footnotes in the financial statements.
Go straight to the debt notes. If they owe a bunch of USD and their revenue is all in lira.
Be very, very careful.
Extremely careful. Unless they are fully incredibly hedged with a reliable counterparty, you aren't really betting on the company. You're betting on the currency.
That is the takeaway. Stability is an illusion when it's built on an artificial peg.
And markets move faster than regulators can ever react. When the exit door opens, everyone tries to run through it at the exact same time, and the door is never, ever wide enough.
We are going to leave it there. A really deep dive into the 1997 Asian financial crisis, the event that taught the world the true, painful cost of trying to cheat the impossible trinity. It's a hard lesson, but a necessary one.
It is. History doesn't repeat itself, but as the saying goes, it certainly rhymes. Keep an eye on those pegs.
Thanks for listening to this deep dive on Talk Tickers. Markets move fast. Keep your stops tight.
See you next time.